Let's talk a little bit about capital availability. These days, the definition of a seed round is somewhere between $500,000 and $10 million.
Yeah, it's a little weird, isn't it?
Yeah, and people are able to raise a lot of capital. Not everybody. Certain people are able to raise a lot of capital and very quickly. Talk about the role of capital constraint and creativity, like the tension between that.
Well, you know, I'm a huge fan that less is more. I mean, we have very small funds at USV. I mean, we could raise $1 billion fund if we wanted to. And you know, we've been shrinking our fund sizes. I'd like to get to a $100 million fund. I don't know if we'll get there. Last fund we raised is $150 million of outside capital and then some partners' capital. So I think that there are some instances where you need a lot of capital to execute a business plan. But in many cases, it's not true. But because lots of capital is available, the company takes on the capital, and then that ends up resulting in no constraints on decision making, and so company decides to do 5 things instead of just 1, and they do 5 things poorly instead of 1 thing well. And I just think that if you are forced to figure out how to get from here to here on $1 million, you'll figure out, if you're good, you'll figure out how to do it.
Yeah.
And so I generally am not a fan of, you know, bigger seeds, bigger A's, bigger B's. In the later rounds, once a company has truly hit escape velocity and they've built sustainable enterprise value, I care about it a little less.
Yeah.
But early on, when it's not clear the company is going to be successful and the decisions they make are going to lead to whether or not they're going to be successful or not, I think too much capital is a bad thing.
What's the right amount to raise if you're 5 people, you've built a product that's about to launch or just launched? I mean, how do you figure it out?
I mean, there's no, it's really hard to say, but I would generally say at the seed round, raise 12 months of capital. At the A and B round, raise 18 months of capital, and C and beyond, go for 24 plus. That's a simple rule of thumb.
Yeah.
Right? Like, a seed that gives a company 4 years of runway, what does that say?
Yeah.
I mean, it means the people raising the money don't think they're going to make it in a year, right? Why would you raise 4 at a seed price?
Yeah.
It's kind of a really bad.
We've seen it. And
it's a bad signal, right?
Yeah.
That an entrepreneur would be willing to take 4 years of dilution when, you know, what they really should do is take a year of dilution and then in a year increase their value 3x.
Yeah.
It means they either don't know what they're doing or they don't have confidence that what they're doing is going to work.